Hi, I'm Kara Murphy, and this is Money with Murphy. In 2025, markets covered a lot of ground, from tariff announcements, which drove the S&P 500 almost into bear market territory, to AI-driven earnings growth and new record highs for the market. Stay tuned for some highlights. The new administration campaigned on the idea of change, including deregulation, tax cuts, and tariffs. The first two, deregulation and tax cuts, are generally seen as positive for the market. But excitement over those moves quickly got overwhelmed by the focus on tariffs and the whipsaw changes around those policies. Now, whether you agree with those new policies or not, markets don't like uncertainty, and large-scale shifts in Washington tend to rattle investors. The result? A tough start to the year. But remember, these things can shift quickly. Tariffs can go up or come off just as fast. All of this has pushed global policy uncertainty near its highest level in years, almost where we were during the peak of COVID. And it's likely to stay elevated for a while as conversations around trade evolve. On the economic front, things are actually holding steady. Unemployment has been pretty flat so far this year. Inflation, measured by the Consumer Price Index, is still sitting around 2.8%, the same where we ended 2024. Newly announced tariffs on goods from a wide range of our trading partners have increased the chances of recession and, understandably, have rattled markets. In addition to the S&P 500 falling sharply, the tech-heavy Nasdaq is down 23% from its December high, and credit spreads have blown out. Having been an investor through multiple bear markets, recessions, and even crashes, the panic currently gripping the markets feels familiar. And so, as we think back to the beginning of this year, we had identified a number of policy risks. One of them was tariffs. Ultimately, though, we don't think tariffs is actually the largest risk faced by the market, because the level of tariffs is less important than just knowing what they are. U.S. companies can sort of resolve around whatever that tariff rate is.
Do you just sort of sit on your hands, decide what you like, buy it, go on vacation?
Well, I like to describe the first half of the year as the Rip Van Winkle market, right? If you had gone to bed on January 1st, woken up at the end of June, you'd be like, I did a great job. Like, I feel really good.
I wish I had.
Right? Don't we all
wish? I've been
wish?
on vacation the
Many
last
people are great.
On many levels. But carry on.
Right, but the challenge is that we all lived through that. The good news is that experience helped us sort of live through what we're going through now.
Recently, the House passed a sweeping proposal that tackles tax policy, spending, AI regulations, more, all bundled into one big, beautiful bill. The Congressional Budget Office, or CBO, released their analysis of the proposal. Their takeaway? If passed as is, the bill would add nearly $2.5 trillion to the national deficit over the next 10 years. That would raise the deficit from about 6.3% of GDP today to an estimated 7.5% by 2034. Earlier this month, a new bill passed into law, officially called One Big Beautiful Bill Act. While the name might be playful, the bill has a wide range of implications for businesses, investors, and individuals, some of which are controversial and others complex. The Congressional Budget Office projects the bill will increase the federal deficit by over $3 trillion over the next 10 years. One big issue the bill doesn't address is non-discretionary spending, things like Social Security, Medicare, and interest on that debt. These actually make up the majority of federal spending and are the toughest to reform. Without touching these, it's hard to see how we grow our way out of this challenge. The real story, though, is who's driving that growth. No surprise, it's technology. 92% of tech companies beat expectations, accounting for almost 60% of the total earnings growth this year. Tech now makes up 1/3 of all S&P 500 earnings, triple its share 2 decades ago. Much of this momentum comes from the AI build-out, with cloud providers, chip makers, hyperscalers like Google, Meta, Microsoft, all investing heavily in the infrastructure that's powering this shift. From March of this year to August alone, the number of ChatGPT weekly active users grew from 400 million to 700 million. That's growth of 75% in just 5 months. And this came after the number of users doubled over the previous 7 months. Over the last couple of years, companies at the forefront of the AI boom have seen their stock prices soar. NVIDIA, which makes specialty computer chips that support AI processes, has been at the forefront of this trend. Other companies such as Microsoft, Meta, Google, Amazon, Apple, sometimes called hyperscalers, have been busy building AI models. Running artificial intelligence engines requires massive amounts of data and power. We could have said all of those things a year ago, right? Valuations were looking fairly high in U.S. stocks, particularly among the Mag 7, and then we had another 12 months of those names continuing to do well. So I think having high valuations alone is not a great timing indicator for the market. What it tells us is that expectations are fairly high and that companies better continue to meet those expectations. So we've talked a lot about earnings momentum and how that's really an important driver of the market going forward. While the decline and subsequent rally were ear-popping, they actually follow a pattern that we've seen again and again. The best days in the market often occur close to the worst days. In fact, over the past 20 years, 7 of the market's 10 best days occurred within 2 weeks of the 10 worst days. In April of this year, if you had sold your stocks on April 8th before a pause on tariffs was announced, you would have watched the rally from the sidelines and locked in a 13% loss for the month. Stocks, bonds, commodities, real estate all posted gains, bringing all of those asset classes into positive territory year to date. Nearly every equity sector in the S&P 500 stock index was up as well, with the only exception being consumer staples, which dipped slightly. This year has been jammed with challenges and rewards. We appreciate you joining us, and tune in next year as we dive deeper into key themes in the market and the economy. And in the meantime, invest wisely, live richly, and happy holidays. I'm Kara Murphy. Tradition, weird historical consequence. As such, these hyperscalers are investing huge. I'm Kara Murphy, and this is Money with Murphy. The last few and risks that come with offering loans to